All right, let's dive in. Today, we're trying to decode what feels like the market's own secret language.
If you just glance at a stock chart, it's easy to see nothing but random noise, right? A total chaotic mess. But what if it's not random at all? What if it's actually a language with its own alphabet, its own grammar, and its own stories just waiting for someone to read them? Well, that's exactly the bet that thousands of traders and developers all over the world are making right now. They're building this whole new generation of tools, not just to look at the market, but to really listen to what it's trying to say. So let's take a look at what they've come up with. Okay, so first things first. If this is a language, we've got to start with the alphabet. And in this world, that means finding completely new ways to visualize the most basic element of all, price itself. And yeah, right out of the gate, you hit a pretty fundamental problem. I mean, how are you supposed to compare a stock that's trading at thousands of dollars with one that costs just a few cents? If you try to plot them on the same axis, the smaller stock's performance just looks like a dead flat line. It's totally useless for comparison. And this is just a perfect illustration of the solution. On the left, you've got 4 separate charts. It's impossible to compare them at a glance. But look at the right. They're all overlaid on one single graph. And suddenly, it's crystal clear which stock was the big winner of the day. So how does that even work? Well, it's actually a brilliantly simple 2-step process. First, you anchor every single stock to the exact same starting line. Let's just say the opening price of the day. Then, you simply scale every movement as a percentage change from that one anchor point. And just like that, boom, everybody's speaking the same language, percent change. So, once we have the alphabet of price down, we're going to need some grammar to give it structure. And in the market, that grammar is volume. It's the amount of buying and selling pressure, that hidden force behind every single move. It's funny. Sometimes the most important signal is a lack of information. This slide shows exactly that. It's what happens when there's almost no volume, creating what's known as a volume gap. Price moves so aggressively, so fast, that it literally skips over entire levels, leaving behind a vacuum where pretty much no one traded. It is a powerful, powerful sign of conviction. A lack of volume definitely tells a story. But what about the opposite? I mean, what does it mean when the trading volume is way higher or even way lower than it's supposed to be for a particular time of day? This is where a tool called Volume Surprise comes into play. It crunches all the historical data to figure out what normal volume should look like for any given moment, like say 10 a.m. on a Tuesday. Then it compares that expectation to what's actually happening right now. And when reality deviates this much from the norm, it flags a major anomaly, a huge clue that something unusual is going down. So now we can take these basic building blocks, price and volume, and we can start to read the big story. We're zooming out here, looking at tools that try to gauge the fragility of the entire market ecosystem. This brings us to a really mind-bending idea from physics called self-organized criticality, and it's summed up perfectly by the physicist Purbake. He's saying that the tiny tremor before a small earthquake looks exactly like the tiny tremor before a catastrophic one. The system itself has no idea what's coming. And honestly, the best analogy for this is a sand pile. As you drop more and more grains of sand, the pile gets steeper, it gets more fragile. Most of those grains do absolutely nothing. But eventually, one single grain of sand can trigger a system-wide avalanche. And the argument is the market works the same way. It just keeps building up this hidden fragility until one tiny little shock causes a massive crash. So how on earth can we measure that fragility? Well, one way is by looking at what's called the volatility risk premium. Think of it like this. First, you measure the market's fear of the future. That's implied volatility. Then, you measure the market's actual chaos recently. That's realized volatility. The gap between that fear and the reality tells you if investors are overpaying for protection against an avalanche that may or may not ever come. And this, of course, leads us to the holy grail, tools that don't just describe the present, but try to use all of this incredible data to actually peer into the future. So for instance, take the theory of max pain. It's a little cynical, sure, but it suggests that as options contracts get close to their expiration date, the stock price is often pushed towards a very specific level, the one where the maximum number of options buyers lose their money, which means the big institutions who sold those options have to pay out the least. Other tools just use pure probability. An indicator called first passage time runs thousands of computer simulations based on recent price behavior. It then calculates the probability of the price hitting an upside target before it hits a downside stop loss. The crucial point isn't just if a price will be hit, but in what order. And finally, some tools are designed to look for recurring patterns. This one, for example, analyzes stocks hitting new all-time highs and has found a really predictable life cycle. You get the initial breakout, then a brief pullback where it tests that old high, followed by a recovery, and then the next run-up. By mapping this pattern, it tries to give you context for where we are in the cycle. So, after all of this incredible math and physics, what's the punchline? Well, it's that this is a never-ending game of cat and mouse. And just to prove the point, one developer took it to the absolute extreme. After building all these complex models, he used this same coding language to recreate the classic video game Pong, right there on a trading chart with real-time market data actually controlling one of the paddles. It's amazing. And this really gets to the true takeaway. We are in a technological arms race. Every single time a new tool is invented to read the market's patterns, the thousands of people using it immediately start to change those very patterns. The market observes, it adapts, and it finds new ways to be unpredictable.
Which leaves us with the final critical question. As our tools for decoding the market get exponentially smarter, does the market simply get infinitely harder to predict? Or, after all this time, are we finally getting closer to cracking the code?